Hey everybody, welcome to today's video. Thanks for tuning in. My name is David. Welcome to my channel. We're going to be talking about how to protect your money during times of recession or maybe just rising interest rates, poor economic conditions. Okay, let's get into how to recession-proof your investments. Now, before we do that, let's just take a step back because I think it's really important that we go over the last 3 years to understand where we are, how we got here, because it's important that if we're going to be doing investing, we hope that all the markets are going to be great going forward. So let's look at where we are today and then we'll move forward. Okay, so this is, if you look at the screen here, you're going to see this nice chart. 3 years of massive gains. You all know this, but this is COVID-19, March 2020. And then we saw this massive run up. Even though it was ugly and choppy and we're all nervous and scared, we had all these mandates to put on masks, to get vaccines, and yet the market still ran up and it was quite choppy. And then you can see here, the NASDAQ ran up over that 3-year period, 90%. The S&P 500 was about 54%, the S&P TSX 33%, and the Dow Jones about 32%. Massive gains. And then boom, a reversal of fortune. 2022 has not been kind. You see here that yellow line, the S&P TSX, that's the Toronto stock market. You can see actually it's positive. In fact, as of today's recording, the TSX hit an all-time high. Now, the US market is a different story altogether. You can see that the markets are all negative here. The Dow -5, the S&P 500 -7, and the NASDAQ more than 13%. So you can see that is a particularly difficult market to be invested in. And a lot of people during this last year and even the last 3 years saw that the US markets was a great place to have their money, and they invested their money. And also, you know, when you pray for rain, you got to deal with the mud. Well, here's the mud. Your negative returns can snap this quickly. Well, what's changed? How did we get to this? Well, the US Fed and the Bank of Canada both announced that they're going to raise interest rates more than once, probably more than 3 times, as much as 5 times. COVID restrictions have been really difficult for everyone, but now they're being lifted, and a lot of companies are asking, well, what does that mean for our businesses? What do we have to do? Hiring employees back. There's a lot of question marks about, is the government going to continue to sponsor, we'll say sponsor, maybe sponsor is the right word, to pay for people to remain working from home? Is it going to be easy for employers to actually begin to hire people back again? All those things are difficult for a lot of people to understand. And then we've got geopolitical conflicts like Russia and Ukraine, and those things, when they come up, they usually just come onto onto our lives in a very dramatic, quick fashion, and then they usually don't last too long. And let's cross our fingers and hope that that is the case as well with this. But when all those things are mixed in, you get tremendous market volatility and uncertainty, and a market doesn't like uncertainty, and so you see some of the assets, especially the NASDAQ, selling off. So where do you begin? How do you figure out, given all of these things and where the market might be going forward, where do you begin to position your portfolio if you're feeling a little bit more cautious than others? How do you structure your portfolio in a way, besides working with an advisor, how do you structure your assets in such a way that you're really more interested in the protecting the downside than you are on the upside? The last 3 years, you're really, let's get it in the market, let's participate in this movement going forward. Now you're saying, conserve what I've made, protect the assets in a place where I'm not quite sure what might happen. So let's look at how that is. The first place is goal-based planning. Now, this is a fancy term that financial institutions began using, goal-based planning, because it really sounds like we're interested in your goals, but it's a fundamental difference in the way that traditional investing takes place. You might see that the typical kind of portfolio is constructed around risk and return. It has really very little to do with your goals. That has been the traditional way to build portfolios, and a lot of older companies who haven't really moved towards this type of financial planning on goal-based planning you'll see that it's not based on your goals, but based on just trying to get a certain rate of return and mitigating risk. Well, goal-based planning looks at this completely different. Goal-based planning takes a number of your goals and assigns time horizons, risk categories to them. So let's have a look at this slide here. So goal-based planning, optimizing an investment mix to minimize the probability of failing to achieve a minimum wealth level within a set period of time. And the way that they do that is they take three categories: your essential needs, your lifestyle wants, and your legacy aspirations. So your advisor has a meeting with you, or if you're doing this on your own, and you'll look at individual goals that you might have, whether it's savings targets, paying down debt, trying to build a nest egg for retirement, having a savings strategy so that you can move in a different direction with your company and have money or capital to be able to do those types of things. These are your goals, and some of them are around what are the essential needs for a living. Obviously, that's important. And then the other things are, things are really going great. What else do we want to enjoy our money? And how else are we going to enjoy our money? Maybe it's, vacations, luxury vehicles, additional real estate positions you might want to be thinking about. And then legacy aspirations, really talking about, what do you want to leave behind? And it's sometimes not just about money, it's your ideals, right? Something that you're building, a company that you build is something to be proud of. And you want to be able to transfer that pride to the next generation of what you've been building and to continue that tradition. So it's not just about money, it's also about this being proud of what you've built. Okay, so the next thing is reviewing your financial plan. I always say this with every single meeting, but it's usually at the end. I'm going to put it right here in the middle, and that is seeing the outcome of your planning decisions before you commit to them. Such a powerful way to look at financial planning is to actually have someone take the time to be able to say, look, if I just have a look at your current situation and map this out for you, here's what it looks like. If we were to do these things, door number 1, 2, and 3 kind of thing, here's what that would look like before you actually do anything. That's a powerful exercise to go through with an advisor. It's proving, on paper at least, that either what you're doing is working, so keep going, or that with some minor tweaks you could have this. Either reduce your risk, reduce the taxes on your estate, grow your portfolios, have less anxiety about the question mark of will I have enough money to retire. Financial plan does this for you. Now, how does current market conditions affect your goals? I always ask people this question because when they make a financial decision, you want to be able to say, well, how is that going to affect your financial plan? It's so important to ask this of yourself. And some people will say, well, David, should I sell in the dip that's been going on? The markets have really gone down dramatically, as I showed you in the first few slides of how much. It was not dramatically, 5 to 10% is not a dramatic change, but it's significant, right? So you want to know, well, should I buy on or should I sell in the dip? And should I just go to cash? Well, timing the market is incredibly difficult. And this is an actual statistic. To avoid emotional decisions around timing the market, the average investor gets 2.9%. And the reason for that is because they try to do this, timing the market. That's incredibly difficult to do. And I'm going to show you some statistics in a few slides to sort of reinforce that, okay? So the next thing you want to do is you want to stay invested. And I'm leading you right to what to put in. As you can see, there's a reason why I'm taking you this way is because I want to share with you what's been going on, what's our current situation. Don't panic, stay invested, and make sure you get a financial plan and you're communicating with somebody that can share some different ideas with you. So let's talk about staying invested. This is the retirement risk. This is the emotional roller coaster that everybody goes on. You can see here, going on the left-hand side, you start with, being optimistic and excited about getting into the investment market, and you see your investments going up, and then they hit a peak and they start to go down, and you wonder, oh my goodness, where is this bottom ever going to be? Are we ever going to reach the bottom? And some people decide to get out of the market And when they do get out of the market, the problem is, when do you buy back into the market? Do you buy back into the market higher than the point that you got out of the market? If you do that, and most people do, you lose twice. So it's important to try not to be emotional about your investments. Be really unemotional. It goes back to your financial plan. What does your financial plan say? How does this affect your financial plan? Is this a critical issue for you, or is this going to be a blip on your investment time horizon? Okay, market timing is difficult. Let's just look at these slides here. I put them in red so you can stay focused on what's going on. The first one is, if you were to, this is the S&P 500, by the way. If you were to be fully invested in the S&P 500, the rate of return would be 7.5%. If you miss the 10 best days, that's the next bar, you split your return in half. So if you missed the 10 best days in the market, 3.35%. Missed the best 20 days, you're just above, half a percentage point. So it just gets worse and worse and worse. So that last paragraph in the middle of the screen, the rectangle, 7 of the best 10 days occurred within 2 weeks of the 10 worst days. Such a powerful thing. So what is that trying to tell us? And that is, when there are these market dips and we look at them as being, the worst, but the best days tend to follow the worst days, and because the market tends to takes a sigh of relief, a big collective breath, and go, okay, it's over, and let's go forward, and the market runs up. That's difficult for you to understand the bottom. And of course, right now during the market where we've got a conflict with Russia and Ukraine, we could get an announcement any day that said they've reached an agreement, everything's over, and the market's going to snap like that fast. And the question is, are you at work? Are you busy? Your lifestyle? Are you on vacation? You're not paying attention. You come back and you say, what happened? How come the market is so high? You've lost again. This is really important for you to see. So staying invested matters. If you look here, these charts, the difference, this is what this is really sharing with you, is the difference between having a short-term mentality and a long-term mentality. If you said, I'm just going to be looking at a window like this, very short, that might be someone who is getting out of the market, or not getting out of the market, but getting out of the employment market because they're going to retire. And the window for investing is very short for you right now because you're about to transition into receiving income out of your portfolio. And you can see over a short period of time of 1 year, you could have as much as 39% losses in your portfolio and as high as 47% gains in your portfolio. This is a massive swing. And the question is, do you want to be in that kind of market during a time of major transition in your life? Long term, you're fine. If you look to the far right, you see long term, those pluses and minuses start to normalize themselves, and you see the upside is much bigger long term than the downside. And so that's really important for you to have that kind of perspective, that focus. So the timing of the market for you is really about the timing of your life. Where are you in the cycle of employment to retirement? That's important for you to get right with your advisor. And it's very important you have constant communication with your advisor at this time. Okay, review your risk tolerance. This is actually very important because when you first started to invest, you probably filled out some kind of risk tolerance questionnaire, and that risk tolerance questionnaire said you're a balanced, or you're a conservative investor, or moderate, or you look at this chart here, aggressive. This is what it really means. Those questions translates you into one of these profiles so that the advisor can understand how to invest their money so that you're meeting those goals and you're not creating too much anxiety by taking on too much risk in your portfolio. And so this is really important. One of the things that happens is you started investing at a younger age and you thought you were bulletproof, and you're going through life and all the things that happen in life, and then all of a sudden something like this happens, or 2008 happens, or COVID hits and the markets decline, and it sends you into a panic. And it's because you didn't keep up to date with updating your risk profile and making sure you start to pull back on some of the equities, the higher risk investments in your portfolio. So this is one of the things you want to examine at every single annual review with your advisor is, has anything changed with your level of anxiety around investing, your time horizons for leaving work and beginning retirement? Have you taken on more debt? Have you taken a pay cut? Have you changed jobs? All those things tie into your risk tolerance, and it's really important to review at your annual review. Okay, let's look at something. It's called the Holy Grail of investing. You can Google this if you want. You can go on YouTube and watch the video. I'm going to do my very best to share this with you today. This is something that was brought to us by Ray Dalio. He's an American billionaire. He's worth $22 billion. He started Bridgewater and Associates. This is one of the single most successful hedge fund companies in the world. This man is a genius. If it's worthy of listening to what he has to say about the markets, about the economy, and about how to construct a portfolio, because the man makes money, and a lot of money for a lot of wealthy people. And so he shared with us his philosophy on how portfolio construction. And I'm going to do my best to share that with you today. Okay. Are you all ready? Because this I know it looks complicated, but it's okay. I'm going to go through this as simply as I can, and we'll go through it one by one. If you look at this chart on the left-hand side, and you say, okay, this is your rate of return, and it's also going to be the risk associated with getting that rate of return. Okay, so on a 10% rate of return, the risk is quite high as well, is what we're trying to say. And the bottom is really the number of assets that you might have. We'll call those return streams. Whatever return means to you, that's a number of return streams, and we'll say up to 20 return streams just for this example. The more the better, but you're going to understand why the more the better. So if you were looking at an investment, a return, and that return was going to give you 10%, but it had a 60% correlation. Now, correlation is when you look at the individual holdings of that particular return stream, how many of them are identical? That's important. So how many of those, if you look at your portfolio, how many funds have Microsoft in each one of those funds? Or how many of those funds have RBC Bank or CIBC Bank? You want to make sure that you don't have a duplication. You want to minimize that as much. And this is really the key here. So in this particular case, if you had a portfolio that was giving you a 10%, or not a portfolio, we'll call it a return stream that was giving you a 10% return, and it had a 60% correlation, you can see it drops the actual risk down by about 15%. This is a good thing. It's important to lower your risk. So the key here, and I hope you can see where we're going here, is how do you have a portfolio that gets you, let's say 10%, but has the lowest risk to get it? This is really important. So if you were to say, well, if you were to add in another 3 or 4 or 5 return streams that had the same correlation, so that means they had 60% correlation, you're not going to get any reduction in the risk to your portfolio, and you're not going to get a higher return. You're still going to get that 10% rate of return. So by adding additional returns, so if you translate this to you, what that might mean is more stocks or more funds like future mutual funds or segregated funds that have the same correlation, it's not going to help you to have more of the same thing. Does that make sense? Okay, so now what if you were to introduce additional return streams that had less correlation? How does that impact your overall risk? So if you look at here, we'll add in another return stream, and we add in another return stream that has 40% and one that has 20%. You can see how as you're adding in return streams that have less correlation, your risk comes down dramatically. And if we had return streams that we introduced that had a 10% correlation, you can see what that does. It is lowering the risk dramatically to your portfolio. And then if you have return streams that had 0% correlation, you can see it's a powerful portfolio. But what does this mean? If you look at this here, if you were to, just on the orange bar, if you had, let's say, up about 7 return streams, you can call that individual stocks, you could call that individual mutual funds, 7 different businesses that are uncorrelated different businesses, you can see that it reduces the risk by almost 50%. This is the key to diversification. This is the power of diversification. In the next slide, I'm going to share with you exactly how that looks for you in your own portfolio, whether you're doing investing in your own, or whether you're working with an advisor, or whether you have money in your group plan. You can just look at this and figure out correlation. Now, how I help clients, this is what I do all day, is I'm trying to construct portfolios that have the lowest correlation possible so that it diversifies their portfolio without having to sacrifice rate of returns. So this is really key here. Now, on the right hand side, you can see this is your return to risk ratio. And so what it's really talking about is the probability of losing money in any given year. So if you look at this here, if you said, well, if I put 7 or 8 or even 20 different uncorrelated, good investments, but uncorrelated investments, that reduces the risk to you to the probability of losing money in any given year at only 11% versus 40%. So the typical advisor might do something like this. They'll put in a Canadian balance fund, and they might have a North American value fund or a North American fund. It doesn't matter really the name, other than the fact that it's North American and Canadian, we'll say. So you can see here, financials is the top holding in this particular fund. Doesn't matter if it's a mutual fund or a segregated fund, I'm just giving you an example. So that means that in the Canadian Balance Fund, there's going to be Canadian banks, Canadian insurance companies. In the North American Value Fund, there's going to be Canadian banks, Canadian insurance companies, and U.S. Banks and insurance companies. But essentially, they're duplicating. There's a correlation of a Canadian bank inside of another fund that has a Canadian bank. Same with IT. If you were in both of these funds, you would probably find the top 3 holdings being Apple, Google, Microsoft in both of these funds. So there is correlation. This is what you want to avoid. This is really something that is not helping you to invest. This is an example of you adding in correlated return streams, and what you want to add is uncorrelated, as much as possible, return streams in your portfolio. So there's the first key to protecting your money in rising interest rates, poor economy, or just the sentiment of that we could be going into recession. You want to begin to have your, and by the way, this doesn't have to be in bad economies. This might be just the kind of portfolio you want to have all the time, where your funds are absolutely uncorrelated or your return streams are uncorrelated with one another. Okay, the next tip to making sure that you can protect your money during bad market conditions, and that is to increase your non-US markets. When we go back to this slide, the reversal of fortune, you'll notice that the yellow line is the Toronto market, the Canadian market, the S&P TSX, and it's been in positive territory while the US markets have been in decline. So one of the things, if you look at this chart here, it says this is the world, the $94 trillion world economy, and Canada makes up, down in the bottom left-hand corner around 7 o'clock, it makes up only 2% of the world's GDP. And why is this important? Because if you want to avoid 98% of the world's problems, just invest in Canada. Now, I'm not saying to only invest in Canada, but there could be, a shift between this timeline where you think that the world is going to be kind of difficult and you want to protect your money but stay invested. So you shift more to Canadian content. I sound like the CRTC here, but you shift to the Canadian content in your portfolio, be a little bit more overweighted in Canada, because it's going to allow you to stay invested into great things that you're already invested in, Canadian banks, insurance companies, that type of thing, but still get a rate of return, still grow your portfolio, but really avoid the problems of the world. Now, the reverse is true too, and that is when things are going really well, you're not participating in 98% of the opportunities out there. So just keep that in mind, okay? Number 9, insurance companies. We're almost there, and I'm going to share with you exactly some of the things you could put in your portfolio. Insurance companies. Why am I putting this here? And that is because, during times of of rising interest rates, insurance companies make money. Insurance companies are inherently conservative, and that means that they're very sensitive to interest rates. When interest rates are low, their margins shrink, and you'll see the dividend in their participating fund. This is life insurance. It tends to go down slowly over time, and we've seen since like 2000 and we'll call it 2008, we've seen it go from, let's say, a dividend of 8% down to 5%. And so it's fairly significant, but you're still making 5%. So what's important for you to consider is, though, that insurance companies in rising interest rates, they make money. About $1 billion for every 1% that the interest rates go up, about $1 billion of profit an insurance company makes. You want to participate in that. There's a company that's going to be making money this year as interest rates go up. They're on the trend of rising interest rates. So there's a place for you to think about putting some money. Look to my videos. You'll see why I've said to you should be thinking about life insurance, because it offers you an opportunity to, first of all, for business owners to not have your money exposed to passive income tax. It's a great tax shelter. You don't pay tax on your investment income inside of the life insurance. So it's an alternative asset class, but it is just a wedge. It's not the end all be all. It's a portion of your assets. If you look here, the stability, so that sort of gold line going through there, while it's been declining over the years, it hasn't been fluctuating like that green line, which represents the stock market. And then you've got your dotted line of a GIC and Government Canada bonds. So you can see here it's a fairly stable, it's the turtle, right? Or the tortoise. This type of investment makes money year over year, and very little volatility. So it's one of the keys to having really good planning, because it's fairly stable. If you look at it from a different way, protecting gains. So when you have a little thing about cash values in life insurance, when you are given a dividend in your life insurance, especially with whole life insurance, I'm not talking about universal life here. Do not get confused about the two products, because they are completely different products. Whole life insurance or participating life insurance, when you're given a dividend, that doesn't go down with market conditions the way that a universal life cash value will go down. Whole life and participating life insurance policies, let's say you're given a $10,000 dividend, for instance. Well, now that's $10,000 that's being added to your cash value, and it doesn't go down from there unless you do a withdrawal. The next year going forward, you're now going forward at that level going forward. So it's like compounding all the way through. That's the power of life insurance. And this chart shows you how that works, in the sense that market volatility can drop at any moment, as you see on the right-hand side, but cash values year over year continue to rise, because they're not subject to this kind of volatility, because it's a hard dividend to you. You actually get the money in your cash value, and you don't pay tax on it. Okay, number 10, shorten bond durations. During times of interest rate increases, you want to shorten your bond durations. So you think about bond durations. If you're in a fund where you're buying individual bonds, and the bond duration might be 30 years, that's not what you want to have during interest rate increases. You want to have shorter periods, because they tend to be less sensitive to the longer duration. A longer duration bond will be more sensitive to interest rate than a shorter term bond. So this is where you want to shift your bond durations, whether you're in a fund that will automatically do that for you. A lot of funds, for instance, when you get these group plans, and they'll have bonds or fixed income, and the bonds in those portfolios, the way they rotate them from equity to bonds or fixed income is based on your retirement timeline, right? So it's you'll see these rotating, where less equity and they add more fixed income, because you're getting close to retirement, so they want to protect your assets. But what we're really talking about is not that. We're really talking about what's happening right now over the next year or two. So you may want to consider changing your bond portfolio to be short-term bonds rather than long-term bonds. Okay, we are to what goes into an investment during times of recession, leading up to recession, sentiment of a poor economy coming forward, rising interest rates. Here's what you put in, okay? Financials. Banks make money during all kinds of economic cycles. So you want to be not heavily weighted in banks, but you want to be in banks and insurance companies. Consumer staples. Focus on what people need in their activities of daily living. What are the things that are most important to them? Groceries, washing, cleaning, brushing their teeth, that kind of thing is important. The next is energy. When you have rising interest rates tend to push energy prices higher, and we're seeing that right now. My goodness, and oil is well above $100, $110 a barrel. And so that's largely because of interest rates going up, and also because of geopolitical events as well. Materials. These are companies that provide raw materials to other companies to produce goods and services. So think about the steel industry that provides steel to build cars, to build railways, to buildings. If you're thinking about, the next one obviously is real estate, but you think about the housing market. The housing market, in order for companies to build homes, condos, apartment buildings, hospitals, all these things, especially in the United States and Canada where they're doing a lot of infrastructure spending, they're going to need raw materials. And so those companies are going to be doing very well in times, even during poor economic cycles, because governments tend to invest in infrastructure during these times. And when that happens, when interest rates goes up, it tends to actually increase the margins for those companies. So that's a place where you'd want to put your money. And then, of course, real estate. Despite the fact that interest rates are going up, real estate is still expected to go up in Canada. And so that would be a good place for you to park your money as well as in real estate. Now, do you have to go out and buy a house, or could you buy investments that hold real estate? So you can still do it that way as well. Well, I hope you've gotten a lot out of this video today. If you did, please like and share the video with everybody that you think needs it, because I think this is one of the most important videos that I ever make in my channel, and that is how to protect and grow your money during times of economic hardship or rising interest rates. I always tell people we take care of your wealth management so you can take care of what's most important to you. Here's my contact information. Thanks again for taking the time to watch this video, and I look forward to seeing you in the next video. Thanks and take care. Bye-bye.